Okay, everybody, let's take a look at Chapter 10, homework problems number 1 and 2 from the final exam assignment folder. And what these problems look at is purchasing a long-term asset and considering what is included in the initial cost of that asset. A long-term asset is an asset that we expect to hold on to for longer than a year. Okay, we have seen long-term assets really so far in context of depreciation. We would depreciate an item like a truck, for instance. So the question here is, and what we're trying to get at is, what is the initial cost that we would put into our books when we're purchasing the asset up front? Okay, that's kind of the question that we're looking to answer here. So let's step through these facts, and we're going to learn just by going through some of the details and then comparing and contrasting and seeing how these two examples differ. So problem number 1 looks at the purchase of land. And we have 5 different layers of cost or types of cost associated with purchasing this land. We have the first we have the cash outlay of $68,000. So that's kind of like what the value of the land was, just on its own. And so there was a seller. We went to the seller and we offered that amount, and they said, okay, $68,000. But then the seller said to us, I also want you to pay the property tax that is associated with the land, and we're going to assume this is taxable property. This is maybe a piece of property that we want to purchase because we want to put a new factory on it, let's say. So the person selling us the land says, well, there's tax outstanding. I owe property tax on this building. I want you to pay that for me. You pay the $68,000 cash, also pay the $25,000. And you say, okay, fine, that's fair. So you're willing to pay the $25,000 of accrued tax. You are also going to have attorney's fees and real estate broker fees, because this is a large purchase, it's a complicated purchase, and you would have an attorney and a real estate broker involved. This is just inherent to a purchase of an asset like land. There are legal implications for purchasing land. We want to make sure that we have free and clear title or ownership to the land. So there's a whole title insurance process that the attorney would help with. We want to make sure that all of the real estate rules are followed and that we fill out all the requisite paperwork, so the broker is involved. Finally, we want to make sure that the land is cleared and graded, meaning we're going to take a bulldozer and maybe some other construction equipment, and we're going to make sure the land is totally flat and ready for use for whatever it is that we're going to use that land for. So each of these costs is required to get the asset of land, ready for us to use. And what the accounting rules tell us is all of these costs will be included in the cost that will go onto our balance sheet, okay? So it's not just the cash outlay. All of these costs are required in order to obtain the asset and start using the asset. So this is what we will call, all of these will be kind of bundled together into the initial cost, okay? Initial cost of the asset. So if we add each of these up, each of these is required. And the other thing I'll just mention, and we're going to see it with the truck, none of these is a recurring expense that we're going to have once we start using the land. Meaning we pay for each of these items while we're purchasing the land in order to get it ready for use, and then we don't pay these costs again. It's like a one-time cost for each of these items. So the total here is going to be $76,500. Okay? And that is what we're going to put into our accounting records. So on our balance sheet, we'll have something that looks like this. We're going to have land and $76,500. And this would be the cost of the land and the value of the land to us as a business. Okay? Now let's look at the truck, because the truck is a little bit different. And we'll see the difference. Different asset. A truck is, a truck versus land, obviously, are different types of assets. But we're going to see with the truck, we have not all of these expenses are required solely to get the truck ready for use. And let's hit upon this as we look through the details. So the first thing to notice is we have cash to purchase. That is the same as with the land. Okay, so this is a cost that gets us ready or that we need to obtain the asset. Then we have accident insurance. Okay, so a truck that we're going to use in our business, we're going to need insurance for, just like if you have a car, you need car insurance. But here's where we're going to start to see a little bit of difference from the land example. The accident insurance is a recurring expense that we're going to use once we start using the truck. It is not a cost required to obtain the truck. So this is not going to be included in our initial basis, our initial cost of the truck. Okay? So we're going to, my red marker is a little light here. This will not be included. okay? This will be a recurring expense. So we're going to see that that would be an expense on our income statement. What we're looking to do right here is figure out what's the cost of the truck that goes onto our balance sheet. Okay, what is the total cost or total value of the asset as it looks on our balance sheet? So this actually will go to the income statement, and we're not going to bundle it up with our initial cost. We're going to strike out accident insurance. Okay, sales tax. This is the tax that we have to pay on the cash amount that we're paying. We are we're purchasing a truck, and what this looks at is basically we have tax. Similar to when you go to the student center and buy soda, you have to pay a little tax on a soda, let's say. Same thing with a truck. Well, the tax on the cash to purchase, that tells us that yes, this is a cost to obtain the truck. Motor vehicle license is similar to a license that we might have for a car. It gives us the right to operate this vehicle on the roads. Well, that's a recurring expense too, similar to the accident insurance, so that's not going to be included in our bundled up initial cost. Instead, that will be a recurring expense that we'll see again on the income statement. So again, this is an income statement item. Finally, printing and lettering. Well, we purchased the truck and then we want to put our company's name on it before we start using it. So that's the idea here. It's a little bit of branding. This is not something we would do on a recurring basis. This will be included. So we will include this in our initial cost. And what we have here is a total cost of $49,600, consisting of the cash to purchase, the sales tax, and the painting and lettering. Okay, similar to the land, we would have truck on our balance sheet, and the value of the truck would be $49,600. We are going to see in problem number 4 that we're going to be depreciating. This amount will be what will be depreciated over time. Okay, that's how we would show the truck going down in value. So what we've learned here is how do we get the initial cost value of the asset on our balance sheet, and this is how we would do it.